In this sense, Ron, you agree with our first guest of the afternoon who said that the market really was sort of over-optimistic right now.
Yeah, I think, Tyler, in many ways that's true. And I would guess, at least this is just a guess at this point in time, that what we've experienced here is a bear market rally. Like corrections in a bull market are short, sharp, and scary. Rebounds in bear markets are short, sharp, and alluring. And so I think there are still quite a number of headwinds, including what you see there. What the Fed won't be able to do by raising interest rates is fix all the things that not only your first guest talked about, but Courtney Reagan talked about with respect to retail. And so I'm not quite sure that we're out of the woods entirely. I think the headwinds still outweigh the tailwinds for the moment. And I think we need to see as much time put into repairing this market as price.
We just talked to Sheila Bair, and her view is that inflation has nowhere near peaked, will peak maybe and start to abate sometime next year. I asked her whether, in the classic cliched parlance, the Fed can achieve a, quote, soft landing. She said no.
Well, it hasn't been done before. And I was talking to my colleague, Lisa Hornby at Schroders yesterday, who's on our fixed income team. And she said, when your only tool is a hammer, everything looks like a nail. And, an oft-used expression. But that's really where the Fed is right now. I mean, when you look at the structural imbalances in the economy, we're short 5.8 million homes, all these shipping costs. Things that have absolutely nothing to do with Fed policy have been causing inflation. The Ukraine war has extended everybody's outlook for inflationary pressures, which was something we didn't fully anticipate coming into 2020. So I think it's rougher sledding, and I think the Fed is right to normalize policy. I'm not sure that their policy maneuvers, however, will have the desired effect, given that much of the inflation we're experiencing now has a lot less to do with monetary policy than prior periods.
Is a soft landing so rare, though, Ron? I'm thinking about what Paul Hickey from Bespoke told us last hour, that the market's typically up after a tightening cycle begins. We know, obviously, just looking at the market's performance over time, the last 3 to 4 decades, it generally trends higher every year with a couple of exceptions. So, is it that unreasonable to think the market can digest this, especially given its bullish reaction so far to a pretty hawkish Fed?
Yeah, Kelly, it's interesting when people say that about, tightening cycles. We also, can go back to Edson Gould, who was a technician in the 1950s to the 1970s, who came up with 3 steps and a stumble, where stocks fall after the third rate hike. And I think with respect to the outlook post-tightening cycle, the Fed usually goes until something breaks. Then they turn around and start easing, and the markets rip to the upside. Apparently, we're nowhere close to that. The Fed's own dot plot, if you will, suggests not just 7 hikes this year, but an additional 4 next year. If we were to see all those hikes in a row, I doubt we'd have the same outcome in this tightening cycle than in other ones. Usually the market starts to turn when it's anticipating the end of the tightening cycle, not when it starts.